I fail to see how you have the Fed cutting with the S&P at all-time highs, equities at all-time highs. You have the average home price in the US at all-time highs. You have gold just absolutely ripping higher every day, just going parabolic, and they're cutting. But the problem here that for the Fed is they keep talking about inflation expectations being well anchored. This doesn't look that well anchored to me. My personal opinion on inflation is probably that it's going to reaccelerate. That's kind of been my view for the past 4 or 5 months, but...
Meet Robert, creator behind the YouTube channel Infranomics. With a passionate focus on macroeconomics, monetary policy, and global finance,
he simplifies complex trends through engaging chart-driven videos. Since 2020, his work has explored topics from yield curves and debt dynamics to the silent depression thesis.
We denominate our whole life in dollars, whether it's prices or wages, home prices, or everything is denominated in dollars, and that denominator is increasingly kind of failing. If the average American and their wages is underperforming GDP, well, what's outperforming GDP? It's government debt, it's government spending as a share of GDP, and it's financial assets and corporate profits. So that's what's driving the U.S. economy and the strong U.S. economy. It's corporate profits, financial assets, net worth of the top 1%. And again, these are outperforming GDP. It's not just that they're going up in nominal terms, they're outperforming GDP. And meanwhile, when you look at kind of the average American, they are underperforming GDP.
Hey guys, welcome back to Less Noise, More Signal. Today, I have somebody on the show that I actually just recently discovered. He's been popping up on my X feed every now and then, but I actually now did some binge watching of his channel, and I really, really like it, and I think lots of the listeners will like it too. Welcome to Infranomics. I think your real name is Robert, is that right?
Yeah, I go by Robert or Infra. It just recently became doxed myself or became public about 6 months ago. So some people still call me Infra, but yeah, my name is Robert.
Yeah. In the end, obviously, it doesn't really matter. That's what the internet is about. Like, you get to meet people, meet people, so to say, whose name you don't even know, but you consume their content on a daily basis, even, and you're so used to somebody's voice, even though you never met. So that's very, very special about the internet, but very cool to have you on. I mean, as I said, I binged watched some of your videos and I really like your content. So I just wanted to bring you on to discuss a couple of concepts that you were going through in your own videos. And obviously I appreciate, I want to send everybody your way. Also, they have to really check out what you do. We'll link to the channel in the show notes for sure. But if you could maybe quickly introduce yourself, how did this come about? Infranomics, did you study along these lines, or where does the interest come from?
Yeah, so I've always been a bit of a nerd. When I was a kid, instead of playing sports or being a normal kid, I would do puzzle books. And I've just kind of always been a nerd. Before kind of macro, I was really interested in medicine. So I would just spend a lot of time reading random PubMed articles, a lot of time. I was especially interested in neurobiology. So that was kind of my first interest, I guess you could say, where I kind of nerded out. But then around 2018, 2019, Robinhood was becoming a thing. And I don't know, there's something about markets that just really kind of spoke to me or interested me. Not just the money part, not just that you could make money participating, but just kind of I looked at it like this massive puzzle, especially with macro, the global macro. It is kind of like the most high stakes puzzle in the world. And one of the more complicated ones. There's so many variables, especially when you're talking, within any given country, there's hundreds of variables that you have to look at. And then, comparing country to country or, region to region, it can get really complicated, but there's something about that was like a challenge to me, and I like challenges. So yeah, just the puzzle element of it and the challenge of it, I wanted to figure out kind of how it all worked. And so I dove head in and took it really extreme. I would listen to like 12, 14 hours of podcasts every day, macro podcasts and academic speeches on you at various economic schools or conferences. I would just consume as much as I could and read Investopedia, Wikipedia, and then I would go on TradingView and Fred and try to kind of like reverse engineer a particular concept or a particular relationship or correlation, kind of forcing myself to teach myself. I have a very strange learning style. Everyone always asks, like, what one book would you recommend to understand macro? It's like, that's not really how I learn. I learn by kind of just diving in, and it's kind of a bit chaotic, I guess you could say, my learning style, but it works for the way my brain works. And yeah, I just I'd say over the past, 5, 6 years, I've taken it pretty seriously. And yeah, then I got to a point where my Twitter account started to kind of gain and went from, like 2,000 subscribers up to, 10, 15, 20, 25,000. And I thought, okay, well, there's something here. Why not start a YouTube channel? Because when I was learning, this was pre AI, this was pre, it was a different time. And most of the macro content was just a bunch of macro nerds talking to other macro nerds. And there was kind of very little in the way of like, you know, let me explain in simple English what this term means or what it represents or what. And so, yeah, that was kind of the goal with the YouTube account, was to just start a channel that, I spent way too much time learning about this stuff. And I thought to myself, it shouldn't, the average American and we'll talk about it later, but the average American that has been hurting so badly economically, financially, shouldn't have to spend 20,000 hours of their life, educating themselves on these various things, to understand how their economic system works, to understand how their financial system works, their banking system, their monetary system. And so it was really a desire to educate kind of the everyday person, if that makes sense.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single tax year. That's right, a 100% write-off. If you have $100,000 in capital gains or income, you can purchase $100,000 worth of miners and offset it entirely. Blockware's mining as a service solution enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day, while also saving big time when tax season hits. Get started today by going to mining.blockwaresolutions.com/LNMS. Again, that's mining.blockwaresolutions.com/LNMS. Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Yeah, sure. I think that's also the reason why it resonates so much with the people that are watching your videos, or why it resonated with me, because it feels, as you said, you're truly like self-made, and it feels like watching an autodidact really dissecting the topics and learning himself, and people appreciate this because they learn along the way. And that, I guess that's always the most interesting part in it all. Maybe just one other like sort of personal question is like, are you nowadays making a living with this, or do you have like a side shot? Is it just a sidekick of yours or gig? Like,
Yeah,
how does that work?
It's getting there. Ideally, yeah, probably within the next few months, I'll be able to make it a full-time thing. But yeah, I have a background in totally different in healthcare. So
Yeah.
yeah, I still do some of that kind of as the day job, but this is becoming more and more consuming more of my time. And with YouTube, like I've been astounded at the kind of overnight success of the YouTube. I mean, I just started it like 5 months ago, and it's already got 24,000 subscribers. So there's something working there. And obviously, with YouTube, some of the bigger accounts, you can make much more than I'm making at my day job. So yeah,
Lol, but
the goal is to probably within the next couple months make it a completely full time
yeah.
thing.
No, but that's again, yeah, that's so interesting. Like again, the internet, making it possible that you can just put something out there and the entire world can sort of listen to it. And if you provide value as you do, then I guess, yeah, your account will explode and then people will just flock to it because you're providing the necessary value. And then, yeah, it's just amazing how things can change overnight, as you said. So truly appreciated and earned, I would say.
Thank you.
Yeah, if we maybe now move over into the topics, maybe one thing I'd like to talk to you about is really you had a recent video on tips, tips auctions, and it's another one of these topics where you nerded out, and I mean for me even it's like a real nerd topic. Some people might not even know what this is about, and I really liked your way of approaching this because you were trying to also kind of figure out what happened post FOMC meeting, with the interest rates announcement in the US. And a lot of people were actually sort of saying, well, inflation might be real accelerating. That's the data. We can see this. And you were looking at this particular market, dissecting and showing that maybe the market as a whole is not necessarily perceiving inflation to be a problem right now. And so if you could maybe take us through your thought process there, that would be very great, and also sort of a learning curve for us as listeners, I guess.
Yeah. So the way a bond auction works is it's in the style of a Dutch auction, meaning you have a starting price of say $100, and you have to go down in price until the entire supply is absorbed. Whatever price is required to get that entire supply to be absorbed, that is the clearing price. Everyone gets assigned that price. So if there's not enough bids at say 90, $95, you have to go down to 80, 85, wherever it is. And with bonds, obviously, that means a higher yield as you go down in price. With tips, it's a bit different. So generally with like a normal bond auction, if you have to go down significantly in price and therefore up in yield, that is generally a sign of weak demand. And that is going to result in what's called a tail, which is a higher yield than the starting price. With tips, it's a bit different. What you're really, if you think about what a tip really represents, and for those that don't know, it stands for Treasury Inflation Protected Security. And what it does is it gives you a interest rate above and beyond inflation. With CPI comes in at 2%, the tip has a 1% real yield, you get a 3% yield. And it gets applied to the principal, and that's your real yield. So you are getting a interest above and beyond inflation. And generally, if inflation is a major concern, you would expect to see very, very strong demand. And sure enough, we did. In 2022, there was very, very strong demand for tips because inflation was raging. I mean, it was 5, 6, 7, 8, 9% and so therefore tips had very, very strong demand because everyone wanted protection above and beyond whatever inflation was going to come in. However, and so therefore you had strong tips auctions, you had a high bid to cover, which is very simply the total supply divided by the bids divided by the supply. And that tells you kind of, is it how oversubscribed, how many bids are there relative to how much are you trying to sell? And higher bid to cover is stronger demand. So you had high bid to covers, you had very, very strong demand back then. Well, if inflation is less of a concern to the market participants, you'll get weaker demand. And sure enough, that's what we saw with TIPS. The last TIPS auction, I believe it was a 10-year TIPS. I tried to pull up one of the slides that I thought I had shown that had the results of the auction, but I don't have it there anymore. But I think it was a 10-year TIP. And yeah, the demand was quite weak. My personal opinion on inflation is probably that it's going to reaccelerate. That's kind of been my view for the past 4 or 5 months, but the bond market didn't appear to agree. You had pretty weak demand. Again, kind of the inverse of a strong TIPS auction. The inverse of that, if the bond market is not concerned about inflation, you're going to have a weaker TIPS auction with lower bid to cover and a higher tail. The TIPS auction did tail by 5 basis points, if I'm remembering correctly.
Exactly,
So
yeah.
that's a pretty large tail for an auction.
Self-custody is one of Bitcoin's greatest strengths. And to truly benefit from it, you need a hardware wallet built with seriousness and world-class security. Enter Bitbox. Bitbox embodies privacy, precision, and uncompromising quality. It's incredibly user-friendly, yet powerful enough for advanced users. You can connect it to your own Bitcoin full node, fine-tune your own transactions with advanced coin control, and even add an optional passphrase for maximum protection. It's also fully open source, echoing Bitcoin's core principle, don't trust, verify. And while not all of us can verify every line of code, trust here is built on something real. I've known Bitbox's core contributors for years, and I've come to trust their expertise and integrity. So if you want to secure your Bitcoin like a pro, go to bitbox.swiss/LNMS, order your Bitbox now and get 5% off. Again, this is bitbox.swiss/LNMS. Exactly, because I didn't know about this either, and then I was obviously just rushing to ChatGPT and I asked it about it, like what has historically been like a higher tail, so to say, and without sort of giving it any information to sort of bias it, it told me, well, higher tails are usually up to or between 4 to 5 basis points, and if you're above, then it's like it's really abnormal, And so this kind of caught my interest when I read about it or when I heard about it in your video, because to me, all I'm hearing right now, and to other people that I'm talking to, that I feel have a good grasp on the market as well, they're pointing to reaccelerating inflation, as you just also said, and that's also why some say, well, the Fed now cutting into this, it's sort of weird, because it's not where it should actually be at. But then again, I feel like you kind of had this interesting perspective with this tip auction, that the market is probably somewhat agreeing with the Federal Reserve and saying, well, we might not see this immediate reacceleration, or at least not inflation being that much of a problem. So that's what I found so interesting about
Yeah,
it.
and it's just one auction. So, you can get kind of month to month noise. We see this with kind of normal treasury auctions too. You get, 1 month there will be a 3 basis point tail, and then the next month it'll stop through, which is the opposite of a tail, indicating very strong demand. So yeah, you can get kind of noise, I guess you could say, with particular auctions. But yeah, I mean, you mentioned the Fed. I fail to see how you have the Fed cutting with the S&P at all-time highs, equities at all-time highs. You have the average home price in the US at all-time highs. You have gold just absolutely ripping higher every day, just going parabolic. And they're cutting. And when you look at the inflation picture, basically all measures of inflation are closer to 3% than they are to 2%, which is the Fed's target. But yeah, especially core. So core PCE is running at like 2.9, and then core CPI is running at 3.1. Annual M2 growth is running at 5%. Yeah, you have significant inflationary pressures, and a lot of that is being driven by services, not so much goods inflation. So I know a lot of the mainstream or the consensus view is tariffs are very inflationary. Well, if you look at the components, disaggregate the inflation data, only about 25 basis points of that 2.7%, 270 bip in CPI, only about 25, 30 basis points of that is coming from goods inflation. The vast majority is coming from services, which, then you start to get into the immigration policy of this current administration, which is, just as, and we'll talk about with the silent depression, just as both parties, going back to the 80s, really, just as both parties dramatically increased the labor supply to keep inflation low, to keep, kind of that disinflationary pressure, just as they did that to keep wage growth and wages low. Well, if you start to dramatically reduce the labor supply, and we just saw this kind of another signpost with this, with the H-1B announcement from Trump that they're going to be charging, right, for the H-1B visa. So they clearly are trying to kind of mechanically adjust wages. Now, whether or not they're successful depends on productivity. Productivity, if you decrease the labor supply and demand stays constant, then mechanically wages will go up. And the problem there is, number one, demand is starting to kind of soften on the demand side. And you also have AI and eventually robotics, which will be providing those productivity gains, which will further kind of reduce the amount of labor that businesses need. So productivity came in very, very hot for quarter two at 3.3%, if memory serves. So yeah, it's kind of an uphill battle that the administration faces, but I think that their intention is to try to, the law of supply and demand doesn't just work for, say, gold or strawberries, the price of blueberries. It works with labor too. The price, or the release valve, is just the wage. That is the price of labor. So yeah, I think that that's their intention, is to try to reduce the labor supply, therefore mechanically boost wages. But again, they kind of have these competing, countervailing force of rising productivity, and from AI most likely. And then you also have kind of a slowing of the economy to some degree, and a slowing on the demand side. Part of that is driven by uncertainty, policy uncertainty. So, it's not exactly the most straightforward, simple, easy sort of thing that they're trying to do. But yeah, I think services inflation is going to continue to drive, so many Americans got put in a very, very deep hole with 2021 through, up until recently. They got dug into a 50-foot hole, and yeah, they might have been able to claw back, come up 10 feet, right, 20 feet, but they still, most Americans still do not have the purchasing power of what they had back in 2019 or even 2020. And so there's kind of this embedded psychological sort of phenomenon where everyone is going to be demanding higher wages. Hopefully, they remember what they were able to purchase with their wage, a week's wage or a month's wage. They remember what they were able to purchase in 2019, 2020. And so I think that there's going to be kind of this structural higher inflation on the labor side of Americans just trying to get back to kind of, the purchasing power that they had a couple years ago. Then you add into it decreasing the labor supply to some degree. I mean, net migration, I think, just went negative a couple months ago. So there's, there's certainly inflationary pressures on the services side. Tariffs, generally speaking, being a tax, are not generally inflationary in the traditional definition of the word. There's a bit of a misunderstanding when it comes to, if you have $1,000 iPhone and a 10% tariff, people think, oh, well, that means the iPhone goes to $100, up by $100. But the tariff is only on the landed cost. So that $1,000 iPhone, most goods from China and Southeast Asia, most of them have about a 50% profit margin, between 40 and 50. So you assume that $1,000 iPhone, the tariff is not on 1,000, it's on 500, right? So then that 10% tariff is not $100, it's $50. And then once you kind of break it down even further and look at who is actually eating the cost of the tariff, about 70% is being eaten by either the foreign firm in China or Malaysia or wherever, and then the importer, which is the US firm. So right now, the consumer's only eating about 20 to 30% of whatever the given tariff is. That tariff is only on the landed cost here, and most margins for goods from Asia are about 50%.
Yeah, very interesting. I mean, yeah, I guess from what I read, there's probably still, the jury is still out on how much of these costs will be passed on, maybe also because, back in the day, just like a couple of months ago, maybe when the tariffs were not yet standing, a lot of firms were able to produce goods cheaper, and they had a lot of inventories and have maybe been running them down. And maybe at some point they might to have to pass some of this on. But obviously, as you explained, it might not be that straightforward. And exactly also the economic case, you can make both arguments, sort of for both sides.
Yeah, and I think if anything, right, the average American will probably just say, nope, not buying it. Even if it's only, a 10% increase in the price or a 5% increase. I think that the median American is so poor and so kind of disaffected with things that once they start to see rising prices again, I think they just say, nope, not going to buy it. So
Yeah.
then you get demand destruction, and it's acting more as a traditional tax would, which is to constrain the demand side.
Yeah, to your point earlier, when you mentioned like this psychological anchor with many people, that they have sort of, and maybe this instant fear of inflation. I mean, to me, it's also quite interesting that if you look at these like surveys, that are compiled by like the University of Michigan or whatever, like these sort of surveys, I think they stand way higher. I think the last one came in at like 4.8% in September. And then if you square this again with the fact that like the market in and of itself with the latest bond auction, even as you said, it might be noise, but it was not in line. And then you also have like if like there's this divergence between the 10-year break even again rate, and oil, which I find also to be very interesting, because like that also sort of used to work or walk in tandem, and now it's kind of bifurcating. And what's your read on this? Because I have a similar divergence that we witnessed a couple of years ago with the real rate and gold. And now maybe the oil 10-year break even rate. There's also has something like materially broken there, or how do you interpret that?
I don't think broken. I mean, we're not seeing a dramatic dislocation or divergence between the two. It is certainly, I think, significant enough to note, but it's not, we're not seeing a dislocation between now with inflation expectations that you mentioned. That I would say that you're starting to see kind of a bit of a a bit of a dislocation. I will try to share the screen. Let's see. There we go. So yeah, here in purple, we're looking at the 1-year inflation expectations for that University of Michigan survey. And then in white, we're looking at headline CPI. And then in red, we're looking at core CPI. So yeah, generally speaking, inflation expectations have not really done what they're doing now. And I think that, University of Michigan, especially, it has a significant amount of political partisan bias within there. If you disaggregate the results, you can see that the inflation expectations for, say, Republicans are quite different from what they are for Democrats. So University of Michigan has some, I don't want to say bias, but I think reflects the underlying kind of political division and polarization that we see in American politics. But the problem here that for the Fed is they keep talking about inflation expectations being well anchored. Um, this doesn't look that well anchored to me. Now they have come in, right? They had peaked at, I think, 6.5% back here in May. So they have come in, but they're still double, about double, or I guess 80% higher than than headline CPI is running at. And so the problem here kind of goes back to the psychological element for the average American, which is if they expect higher prices in the future, which this is some measure of that expectation, then they will demand higher wages. And those higher wages equal more money in the pocket of the average American, pushing prices higher as they spend that money. So you get into what's called a wage price spiral. And yeah, if I was Jerome Powell, I would be paying more attention to this. But obviously, they're kind of in this being forced into this fiscal dominance sort of approach where, assets at all-time highs, inflation at basically 3%. And we're going to cut not only 25 basis points today, but we're going to indicate 2 more cuts throughout the rest of the years. It is what it is, but I think that inflation is likely to head higher, especially once we get the degree of Fed rate cuts that Trump is pushing for. I think that inflation starts to move meaningfully higher. Trump is pushing for, 300 basis points of cuts. But yeah, I mean, the degree to which inflation could really start to take off again, I think is dependent on oil. And so, yeah, we'll look at that here. The divergence you had noted between here in purple is oil, BTI, and then in white is the 10-year break-even inflation rate, which is derived from the tips relative to the nominal 10-year. And so, yeah, oil has been trending down. Generally, this has a pretty strong correlation. Oil has been trending down. However, this break-even inflation rate has been trending up. I think that, yeah, I look at the fiscal, I look at deglobalization, I look at the kind of populist immigration policy, again, decreasing kind of labor supply, trying to boost wages, which historically for many decades was seen as a bad thing. Wage growth, in the eyes of most kind of these neoliberal sort of, policymakers and economists, wage growth wasn't negative. And you still see them talk in that way. Lawrence Summers is one of them. And so I think that you have a number of inflationary forces. Really, the only one that is disinflationary would be AI. But the degree to which that can manifest and the speed at which that can manifest is ultimately a question. I don't think that you get, now look, productivity did come in quite strong for Q2. So maybe it's starting to show up. I haven't seen any high quality data that really gets into the productivity of AI, the productivity gains, if there are any. I would imagine that there's starting to be some around the margins, but to get it to offset the fiscal inflationary impulse of running, say, a 7% pro-cyclical deficit, headed to 7.5%, or deglobalization, or kind of this populist immigration policy, to offset the inflationary forces there of those factors, you really have to have pretty significant productivity gains. AI really has to kind of manifest quite quickly and quite significantly. And I just think that overall, the bias is probably towards higher inflation. And break-evens, maybe they're reflecting that reality. They are basically range-bound. If you look the white line, it's basically range-bound going all the way back to 2022. So it's not breaking out in a significant way. That's why I said it wasn't, a significant dislocation where you see inflation or break-even, rates go sharply higher. There's basically in this range here.
Yeah, but exactly as you're pointing out, it's exactly correct. It's just it's not following the oil chart, so to say, and that's why I was like, yeah, maybe it's a false signal in the end, but there is some bifurcation, at least because oil has been going down. And because I'm bringing this up because I'm just reminded of the gold price versus the real rate. That was something that was shown ever since 2020, Russia war broke out, and people were like, oh, this is maybe only temporary, don't care about this. But then now we're almost 3 years in, and it still is it has even widened, and back then, I guess, or at least from what I can see, and so the question is something with oil and break even happening there that you should pay attention to? Or yeah, that's just because as an investor, I think it's very important to, if something has really materially changed, you also want to adapt your framework, and so that's why I thought bringing it up. But maybe you have any comments on this as well. Yeah.
Yeah, I think gold is being driven by, look, it's not just America that is in significant fiscal distress. It is kind of the developed world, developed economies writ large, whether it be, Europe or Japan, even China, very high debt load. So I think, yeah, gold, and, you kind of factor into that the geopolitical tensions and kind of this multipolar world emerging. We saw in 2022 with what the prior administration did with U.S. Treasuries. We saw what they were able to do to, if you had stored your trade surpluses in U.S. Treasuries, well, now you're worried. Are they going to seize those, that wealth, that value? Are they going to basically default on those treasuries? So yeah, there's a degree of concern, I think, that is warranted between for foreign governments, that especially those that, like China, that run very large trade surpluses, or current account surpluses. They need to find something to store that value in. And I think that it's increasingly gold. And I would just point out that, a lot of people will talk about the gold price. This is gold denominated in dollars. However, the dollar denominated in gold, if you think about gold as a FX cross, the dollar denominated in gold is doing this. And so the degree to which it's expecting either probable, there's some degree of future expectation of a loss of purchasing power. Then you also have kind of the actual value proposition of gold, which is starting to increase. The value proposition there being that's a scarce bear asset. So some degree of kind of all of that, and huge amount of central bank buying. I think that it's sending a pretty, if you're an American, it's sending a pretty scary signal here, which is they are pricing in, a significant decrease in the purchasing power of, a given currency unit, which we use the dollar here. And, we denominate our whole life in dollars, whether it's prices or wages, home prices, or everything is denominated in dollars. And that denominator is increasingly kind of failing, very similar to, the general concept of what you would see in, say, Argentina or Turkey, where the underlying currency is, starting to, we are nowhere near the hyperinflation of Turkey or Argentina, but the kind of underlying theme there is constant and consistent between those, which is the underlying unit of account is rapidly losing value. And so I would encourage people, when you see gold just ripping higher, going parabolic, going absolutely vertical, just remember that is gold denominated in dollars. But when you're looking at the dollar denominated in gold, or, home prices denominated in gold, if you look at home prices denominated in gold, it's, basically at an all-time low.
Yeah.
Average home price denominated in gold, basically at an all-time low, meaning record affordability. This is obviously in sharp contrast to the home price in dollars, which has really never been more unaffordable. And the same thing is true too for the average hourly wage, denominated in gold as well. So it's a story of an issue. It's not a complete failure yet. But when you look at the average hourly wage in gold terms, this gets into, I think, the silent depression stuff that we were going to talk about.
Yeah, exactly. I want to move on to this topic for sure. But maybe just quickly, I mean, the point that you're making, it is very valid, because like for me being a Swiss, I might have another reference currency, which is the Swiss franc, and even there, I mean, if you probably chart gold against the Swiss franc, it might not be as vertical, and or maybe, but not just as crazily vertical as it is with the dollar, just because we can see, it might not entirely be the gold price going up, but it might be the dollar going down, and that's what people now have to understand as well, and I think that's certainly something we can point to as well. Yeah.
Yeah, the Swiss franc is probably the only currency that I would personally want to hold for very long. Switzerland, you have a much healthier fiscal health, and much more responsibly run government finances, and there's a degree of the gold picture there as well, for sure. But yeah, I think that even when you look at like the S&P 500, sure, in dollar terms, the Nasdaq and the S&P 500 are up significantly. But once you look at it in euro terms, for example, to adjust for the weakening of the currency, I had this prepared for a video I was going to do today. So here we can see, year-to-date performance, the DAX, euro denominated asset, up 17.5%. We have the S&P in dollar terms, which is up 12.7%. Sounds great until you realize that the DXY, the dollar index, has had one of its worst years in a long time. And so with that weaker dollar, once you adjust for that by looking at, say, the S&P 500 denominated in euros, you're actually still down on the years. Yeah, the kind of it's not a complete failure of the underlying denominator like you would see in, say, Lebanon or Argentina or Turkey, right? We're not anywhere close to that level, but there's a substantial amount of weakness that we're starting to see in the DXY and the dollar, both in terms relative to other currencies, right, like the DXY, but then also in terms of domestic purchasing power here at home for goods and services. And then pretty much, home prices are basically at an all-time high. For someone young like me that would like to buy a house, that's one of the kind of, first things that I think about is, was the average home price doing in dollar terms? And then you compare that, of course, to gold, and it's a totally different story.
Yeah, exactly. Yeah, well said. I mean, before I want to talk about the silent recession thing, another last anomaly that you shed some light on, and it might be jumping around here, but it's like consumer sentiment versus real GDP, or like you were pointing to the fact that I think if we look at some general surveys again, like consumer confidence is generally low. It's not like in the highest, I guess, but then you were also pointing to the fact that like 50% of all consumer spending is done by the 10% of the richest people, and that's why this bifurcation again is coming from, that maybe consumer, it's not that it's very weak or something, but still, it's being driven by maybe a small cohort of people who have been doing really well because of asset price inflation. So if you maybe could pull up these charts or explain this situation, how you're thinking about this would certainly shed some light on the situation and help people understand this.
Yeah, so what's really going on here is you have financial assets. If you look, we'll look at we'll look at personal income as a share of the money supply, for example. This is why it's really important to use alternative, I guess you could say, denominators, is because in nominal terms, everything looks like it's great. When you look at personal income, personal income in M2 money supply terms, and obviously this is the personal income, which is a broad way of measuring the money supply, or excuse me, broad way of measuring income. It includes far and beyond just kind of average hourly wage, for example, which is which shows even more weakness. A personal income includes, it's a broader way of measuring other forms of income. And even then, when you look at it as a share of M2, which is a kind of you can think of it as, what, if you're making $100 in income, but the money supply is going up, say your income is going up at 5% per year, but the money supply is growing at 20% per year. Well, you're actually, even though your income is growing in nominal terms, as a share of the money supply, it's actually shrinking. So I like to use the money supply M2 as a denominator. And, here's kind of a chart for the average American. We can see that personal income as a share of M2 has just been down and to the right. And the same was true, by the way, here in red. We were looking at the average hourly wage divided by gold. And the average hourly wage in gold terms has been down and to the right. Going back, the peak here was March of 2001. And if we go here, it was about May of 98, maybe here in early 2000. It's kind of tough to say where the exact peak was, but the late 90s, early 2000s, both of these metrics peaked. And that's this, kind of the health of the average American. And the average American, was driving the kind of US economy, especially, post as we kind of deindustrialized, consumer spending became more and more of a driver. And so something like this, the purchasing power of the average American's wages obviously being quite important. But yeah, what has happened is, even though that has fallen, if you look at the return of financial assets relative to wages. Like one of my favorite charts is this one, which is the S&P 500 divided by the average hourly wage. In simple terms, this tells you, how many hours of work at the average job must you work to get 1 unit of the S&P 500. And of course, it's actually even worse here. If you use total return of the S&P 500, including dividends, it's actually even worse. But what we can see is that, back here in the 60s through the 70s, this kind of bounced between about 10 to 20 hours of work for the average American to get 1 unit of the S&P 500. Well, that is 202 hours of work for 1 unit of the S&P 500. Now, you had, if income and the average American is underperforming GDP, which is the case, then you have to have something fill the gap. You have to have something outperform GDP. So, S&P 500 is one of those, and it just being a proxy kind of for financial assets. The S&P 500 has been outperforming GDP to a significant degree. Here we can see S&P 500 divided by GDP. So we are getting increasing debt, right? The bureaucracy, the government spending as a share of GDP has doubled over about the past 40, 50 years as a share of GDP, about doubled. And then you have financial assets, which have outperformed GDP. And then, of course, debt. So debt to GDP has increased quite rapidly over the past couple decades. So those are the things that are outperforming GDP. When you look at, everything else, kind of the health for the average American, that, incomes have been underperforming GDP.
Yeah, exactly. And I think this is exactly what you mean when you talk about this silent recession theme, right? Why do you call it a silent recession? And is there any other data to back it up with? I guess as you just showed, S&P divided by hourly average wage, this is probably one. But yeah, why is it the silent recession, so to say?
Yes. Labor force participation rate is another one that I've kind of noted as being an indicator of this. And you can see that this peaked, that is in yellow, that peaked in same period of time, which was kind of the late 90s, early 2000s. By the way, the China shock, China's admission into the World Trade Organization, that was around November, December of 2001. Civilian labor force participation rate, that peaked in, call it, 2000. You had the average hourly wage in gold terms, that peaked in 2000. You had personal income in M2 terms, so real purchasing power or the share of personal income as a share of M2, which has declined from about 182% of M2 down to just 117% of M2. Average hourly wage in gold terms, if you look at the S&P 500 in gold terms, that also peaked in 2000. And yeah, when you look at kind of the hyper financialization that has occurred over the past 2 or 3 decades, we've, deindustrialized our economy and turned it into this, again, if the average American and their wages is underperforming GDP, well, what's outperforming GDP? It's government debt, it's government spending as a share of GDP, and it's financial assets and corporate profits. So if you look at corporate profits, those are outperforming GDP as well. And so that's kind of what the modern day American economy has turned into. Net worth of the top 1%, that is outperforming GDP. So we've turned our economy into something that, who is really driving GDP, who is really driving that kind of aggregate economic output. It's government spending, it's government debt, the accumulation of debt, which again we're going to have to reckon with at some point or another. It's corporate profits and it's financial assets. So at the expense of the average American, who again personal income as a share of average hourly wage in gold terms. There's a number of metrics. Labor force participation rate as well. Corporate profits have basically doubled as a share of GDP if we go back here to kind of the 80s. And by the way, I'll point out the last period of time where you had populism in the US, corporate profits and the return of the S&P 500 relative to GDP, S&P 500, or put another way, GDP grew faster than the S&P 500 during that last period of populism. You also had the S&P 500 in gold terms, which dropped significantly. I think it was about 85% here from 65 into 1980. So, useful historical analog to kind of, we had very similar kind of social or cultural divisions, right? Kind of during that era. And yeah, corporate profits as a share of GDP did not do the best. Financial assets, S&P 500 relative to, say, GDP underperformed. And, we saw personal income as a share of M2 actually rising during that period of time while the S&P 500 financial assets underperformed GDP, corporate profits basically flat depending on, when you start that evaluation. The corporate profits were not exactly doing the best. And so, yeah, I think that it, could be a useful analog. But going back to, say, the China shock here in 2001, corporate profits were about 5% of American GDP. Well, now if you look, they're 12%. So since the China shock, the average American has had his job shipped overseas, and corporate profit margins are exploding higher, and therefore the S&P 500 is benefiting, right? Financial assets like equities benefit from that sort of thing. So yeah, it's not been the best for the average American.
Yeah, I see. And exactly. So if I summarize, this is really why you call it the silent recession, just because like if you look at what's outperforming in real terms, even it's probably corporate profits. It's as you said, it's debt, it's like everything that's close to the money spigot, that's profiting off of this. It could be people that profit off of government spending. To some extent, it might be like normal people who are on the receiving end, but this is just maybe to make to balance things out. But who's really outperforming is those people holding the assets, because they're disproportionately profiting or benefiting from all of this. And so that's why you call it a recession or a silent recession, that it's not really showing up nominally in the data. And that's why nobody says, yeah, we are outright in a recession. But if you then change like a simple change to the denominator, really, kind of shows you the light, so to say, in terms of, okay, what's actually happening under the hood, right?
Yeah, so I had mentioned it's even worse if you use the personal income is a pretty broad way of measuring income, all inclusive of even like investment income and that sort of thing. So once you look at like the average hourly wage, just the kind of non-supervisory income of the average non-supervisory employee, here we're using kind of a formula based on the average work week to calculate the total amount of wages based off of the average hourly wage. And then we're taking that relative to the M2 money supply. And what we can see, it's even worse. So you can think of this as total wages as a share of the M2 money supply. Back here, they were about 80, 81, 82% of the M2 money supply. Now they're only 44%. So over the past 40 years, you've had a 50% decline in the total wages earned in America, again, based off the hourly wage. And the labor force at any given time, you had a 50% decline in those total wages as a share of the M2 money supply. And this is especially pronounced from the late 90s onward. And I'll also point out M2 money velocity also peaked around 2000. So you have a number of metrics that kind of peaked and showed that ever since, call it the past 25 years, the average American's been hurting. And yeah, in nominal terms, GDP might be okay. But what is really propping up GDP? It's government debt, it's government spending, it's corporate profits, and it's financial assets. And of course, the net worth of the top 1% is also outperforming GDP to a significant degree as well. So that's what's driving the US economy and the strong US economy. It's corporate profits, financial assets, net worth of the top 1%. And again, these are outperforming GDP. It's not just that they're going up in nominal terms, they're outperforming GDP. And meanwhile, when you look at kind of the average American, they are underperforming GDP.
Yeah, I see. You had another very interesting ratio that you showed in one of your videos, where you were comparing private bank money, like total loans and leases, against M2 money supply, and you were sort of arguing that this was growing faster than M2 money supply until 2008, and then this uptrend sort of broke. Maybe why did it break? You have any sort of insights into this or thoughts? And then also, just in general, I was trying to think about how does this actually work? Because I always kind of thought, okay, private bank money, when this is growing, M2 is also supposed to be growing because the broad M2 money supply is the banks creating or like borrowing money into existence via loans that they give out. Yeah, how do you make sense of this?
Yeah, so here we're looking at the monetary base, or M0, relative to M2. So M0 divided by M2. And with these relative charts, when you have the line going up, what that is indicating is the growth rate of the numerator is outpacing the growth rate of the denominator. Clearly, both M and M2 are up and to the right. But this is telling you the rate of change relative to one another. And yeah, what you could see going back to 1960 all the way through, really, I mean, even kind of discounting this little rise here, all the way up until 2008, generally speaking, the narrow money, which is comprised of currency in circulation, issued by the government, and then the bank reserves issued by the Fed. Those are the two components of the M0. So you can think of the M0 as kind of official government money. And then M2, like you were mentioning, is the broader measure of the money supply. And this, a large degree of our M2, a large degree of our money in general, is actually issued by private banks. When they extend a new loan, they are creating money, they are printing money. I think 2008 was clearly a pretty major turning point. And this is not the only chart that shows it, but this shows the degree to which that M0, or that government money, the bank reserves, which are printed during QE, and then currency. This is mainly driven by bank reserves, by the way. The currency component of M0 is not really driving what we're seeing here. It's bank reserves. So I think it just shows the degree to which QE really kind of, we entered a new era. And it's also, if you look at like total debt held by Federal Reserve banks as a share of total gross government debt, that's another one. We can look at the central bank balance sheet relative to GDP. Prior to 2008, it was about 6% of GDP. And now it is 22%. At the peak here, it was as high as 35%, 22% of GDP from, again, going into 2008, it was about 5-6%. So you've had a notable increase in kind of what you can think of as the government side, the official side, stepping in to plug various holes. And I think that, to some degree, there's a kind of a de-dollarization trend going on there as well. If you look at foreign held debt as a share of total debt, it's not pulling up here. Let me sort this. Federal debt held by, if you look at this, which is federal debt held by foreigners as a share of total US government debt, we see again, there's been a decline going back to 2013. And this was obviously during the height of QE. So yeah, like foreigners are stepping away from buying the debt. We are kind of entering this new era, in the long-term interest rate cycle regime of higher inflation kind of structurally due to, again, fiscal, the deglobalization, and then you add in populist policies. So you have to fill the hole somewhere. And of course, we've also had subpar, subtrend GDP as well following 2008. We had very low inflation, but we also had very low growth compared to what it was in 50s, 60s, 70s, 80s, even the 90s. We have very low growth, very low inflation. And so, yeah, what you see is, to an increasing degree, whether it's, the balance sheet as a share of GDP, whether it's the foreign held debt as a share of total debt, all of these metrics are kind of indicating the same thing, which is the government is being forced to, the government being the Fed and kind of the official side, is being forced to come in and kind of plug a lot of these holes to an increasing degree, because again, foreigners, stopped buying our debt back here when this peaked out at about 35%. believe this was during QE2, the end of QE2, maybe the start of QE3. Ever since then, that 35% share that foreigners held of US government debt has declined to 25%. So when it comes to de-dollarization sort of narrative, it's arguably already started.
Yeah, and would you say this is related to this private bank money, total loans and leases versus US M2 money supply? I mean, if you could maybe pull up this chart because yeah, that was something I found very interesting as
Yeah,
well.
so private banks have also kind of stepped away from, one of the reasons during the 70s into the early 80s, one of the reasons that higher interest rates were so effective at curbing inflation was private bank credit creation was driving the majority, as we can see by the way here. Put another way, M2, which is that broad money including private bank credit creation, the denominator, which is M2 that includes private bank credit creation, was outperforming the monetary base back then. So you were able to constrain the prime driver of the money supply, which was again kind of the private bank credit creation side. It's a much different story, kind of post 2008, where you have M's just dramatically kind of outperforming M. And I would say that probably during the next crisis, this takes an even further leg higher. The foreign held debt or federal debt held by Federal Reserve banks. That's another interesting one. So federal debt held by Federal Reserve banks as a share of total debt. There's so much to say on some of these topics. This has also dramatically increased post 2008. Now, it was high back here in the 70s, but obviously as debt to GDP in general, we were able to kind of deleverage. Debt to GDP got quite low in the early 80s. But yeah, post kind of in recent era, this is debt held by Federal Reserve banks as a share of total debt. This has increased quite dramatically as well. Now, every QT cycle, they try to kind of bring these various metrics back into balance, but we can see that they kind of never quite get back to where they were going into the crisis. So, you would define that as kind of an uptrend. And yeah, it's very likely that during the next crisis, it gets even worse.
And I guess, these like sort of more public balance sheets, be it the US Treasury or be it the Federal Reserve, stepping in here and plugging the hole. This is also leading into what you kind of coined the Amerizuela, like America and Venezuela. Like, yeah, can you lead us through this or contextualize this as well? What do you mean by this term? And is it really the case? Because as you say, or try to show now, it is like everything is shoved or shoveled onto the public balance sheet, where it seems to be the end all story, but it's probably not, and that's why, yeah, the US on its front, when it comes to its debt, it's also been deteriorating. Or what do you mean by Amerizuela?
Yeah, so we had the dot-com equity bubble, obviously in the late 90s, early 2000s. By the way, that was to some degree caused by the fact that being the reserve currency issuer of the world, we had stopped running deficits and started, actually with running a balanced budget and or even a budget surplus, which meant that the foreigners, which again need to purchase and hold dollars. There was not enough net new debt being created from kind of that mid 90s and through the late 90s. So they were forced into equities. That was part of what drove kind of the dot-com bubble. But then you also, once the dot-com bubble popped, then you had kind of an intentional effort I think it was Ben Bernanke that I believe that talked about purposefully kind of creating a housing bubble. And that was, you can find, I can't remember if it was Ben Bernanke. One of the major policymakers at the time had spoken publicly about the need to, it might have been Lawrence Summers. I can never quite remember, but people can find that. And then we shifted into this kind of housing bubble, which by the way, was also kind of influenced by the fact that at the last time the current account deficit as a share of GDP was above 5%. It was, I think, between 5 and 6% of GDP back then. The other side of that is a 5 to 6% current capital and financial account surplus. So foreigners were kind of forced into financial assets here in America. Even The Economist which is a generally pro-globalization sort of magazine, even they were kind of forced to admit that in an article that part of 2008 was caused by that very high trade deficit, that very high current account deficit. And so, yeah, now there's nothing left to transfer. There's no other bubble to blow other than a sovereign debt bubble. Luke Groman always says, that the equity bubble got kicked up to the housing level. The housing bubble got kicked up to the sovereign level. I think it's a really good way of kind of conceptualizing it. And there's really no, past the sovereign debt bubble, there's really nothing left to.
Yeah, where do we kick it up to?
Yeah. And so really the only option that they have here is to a significant devaluation of the debt in real purchasing power terms. And if you look at, TLT divided by gold, Luke and I think both of us, it's like our favorite chart. I always hear him referencing it and I'm always referencing it. I think it's a really good way of kind of visualizing the trend, which is, the value of the debt in real terms must continue to lose value. And that's inflationary. It is what it is. We have kind of gotten ourselves into the situation where we feel like we can, this is unadjusted for dividends and this is adjusted for dividends for TLT. So including the yield, this TLT divided by gold. And the same is true with TLT divided by the S&P 500. You have to have a devaluation of the debt in real terms. There's a number of ways of going about this. They can try negative real rates, which is where you run inflation hotter than the cost of the debt. Generally speaking, especially after the inflationary period of 2022, the bond market is going to be hesitant to allow that to happen. We saw this, by the way, the kind of psychological element of it. We saw that back in the 70s and into the early 80s. The bond market demanded a very high real yield. For a while after inflation fell, you could see that the bond market, like with the 10-year treasury, was demanding a pretty substantial real yield. I want to say it was like 8% in the early 80s, 8% in the early 80s. And that's what happens when you scare people or impoverish people with high inflation. It's not just the average American that becomes where inflation becomes ingrained. It's also the bond market. So bond market's going to be hesitant to allow inflation to run hotter than the interest, the yield that they're getting. And so, you'll see kind of these continued pressures, at least at the long end of the yield curve, probably, higher yield, lower bond value. And at some point they're going to have to just kind of put a lid on it, right? They're going to have to artificially, whether it be through QE or yield curve control. I mean, you have Trump talking about 300 basis points of cuts. So that would take the federal funds rate down to 1%. Well, of course, CPI is at 3.1. So you're already talking about a negative 200 basis point real rate. That's inflationary, number one. That's stimulatory. And you have them discussing a further shift into treasury bills, into short-dated debt instruments. Short-dated debt instruments are less volatile and therefore more readily levered into new currency units. They are the global collateral for at least, especially in America, they are the collateral for that further kind of credit creation. So, they're more cash-like, they're more liquid, they're more money-like. And so, that's inflationary too. That's stimulatory as well. So you kind of take this full picture of, okay, so they're trying to shift even more debt issuance into these short-term bills, very cash-like, very money-like, very low volatility, and therefore readily levered into new dollar units. And they're trying to cut, the short rate by 300 basis points. I mean, I think Trump even started talking about 350 basis points of cuts. When you have inflation at 3% and assets at all-time highs, this is kind of going back to the denominator and the collapse of the denominator of being the dollar. This is what you see in Turkey. This is what you see by the way, in Turkey, you also see kind of an erosion of the central bank independence, which is what we're seeing also here in America. Yeah, I've been kind of pointing out these emerging market dynamics and it's not a political statement, right? It's not just that I dislike the current guy. I was saying it back, I think, in the summer of 2024 as well. You start to see, political persecution of your political opponents. You start to see some of these things and what's happening in markets as well. The default on the foreign exchange reserves held by Russia, right? Some of these signposts, and I think that emerging market characteristics are just kind of increasing over time. But yeah, the debt must be devalued in real terms. That's kind of at the end of the day, that's just mathematically what must happen. And the problem is we're getting negative returns on each dollar of debt. That's another major problem. So if you look at GDP relative to M2, that's been declining. If you look at GDP relative to the debt, just another way of thinking about debt to GDP, that's been declining. So yeah, we're getting kind of lower marginal productivity of each dollar of debt, requiring more debt to be issued to get the same $1 of GDP. And the same is true with the money supply. You see GDP, uh, you know,
Yeah, I mean, that's exactly right. There's like a marginal declining utility, declining marginal utility to the production of more debt, and then like what one unit of debt gets you in terms of economic growth, and that's certainly what people need to understand as well. I mean, we've gone over an hour, and then it's so interesting. I just want to add maybe this one last thing, because if there's one take home message, it's really about the denominator, that you have to kind of adjust to and really see things in the correct light, so to say. I guess there is also this one very interesting book. It's called When Money Dies. Maybe you have read it as well by this guy Ferguson, where he talks about this during the Weimar Republic, in Germany, when we had this hyperinflation, and then people there were also thinking they're getting rich and ever richer, but if you look at it in hindsight and that yeah, it was just because of the currency collapsing, then it might have not been real wealth that was created, but actual just nominally, and so that's so important.
yeah. So I haven't read that book. It's on my list for sure. But yeah, that's basically what we're talking about. I mean, if the dollar has not only currently lost a significant amount of its value, as any American can tell you, car insurance is up like 300% over the past couple. I mean, it's crazy. Everything is more expensive. So in domestic goods and services, for the average American, the dollar has already lost a significant amount of its value. And then again, I think what the gold market is indicating is a further deterioration of the purchasing power of a dollar. And so when you look at something like the S&P 500, that's denominated in dollars. Once you denominate it in gold, here we're looking at the average sales price of a US house divided by gold. Again, it's basically at record low prices. Just pick a point back here in 2006. The average home was 500 ounces of gold. It's only 137 ounces today. So
Yeah.
what that indicates, and of course, the home price is up and to the right. So what that indicates is it's not necessarily, now there's the income story. There's certainly the degree which higher interest rates are playing a factor. There are some caveats and some nuance. But in general, the theme here is that, if the dollar is losing its purchasing power, yes, the price of a haircut is going to go up. Yes, the price of strawberries is going to go up. Yes, the price of a home is going to go up. Yes, the price of the S&P 500 is going to go up. Is not because it got more valuable. A home is still just a wooden box that you live in with some plumbing, some electrical, right? That's all it is. Gold is still just a shiny rock,
Shiny rock.
that's pretty to look at, right? So it's not that these when you see the gold price going parabolic, just vertical, it's not that gold is getting necessarily any more inherently valuable. It's just that the market is pricing in the current and future deterioration of each dollar purchasing power, right? That's why when you invert the gold chart, you're looking at the dollar denominated in gold, which tells you, right, how much gold. Unfortunately, TradingView doesn't have that metric, but to give you the precise, how much gold $1 will buy you. That's really what's being indicated here. And I think that, like, when it comes to the S&P 500, which is what we're looking at in purple here, the S&P 500 divided by gold, by the way, this also peaked in the early 2000s. Of course, there was the equity bubble, so maybe some degree of distortion there. But yeah, I think this is going to be the way to judge whether it be average hourly wage, right? Your wage gains. I think denominating it maybe in gold terms is probably a better way to really get a picture of your your success, your wealth, your purchasing power. And same thing with, like, say, assets, whether it be home prices, whether it be equities. I think in dollar terms, home prices will probably continue to go up. I mean, that's generally
Yeah.
what happens, especially if you're running negative real interest rates. The K-shaped economy has allowed the upper leg of the K. You'd mentioned the top 10% of income earners driving 51% of consumer spending. Well, the upper leg of the K, especially the wealthy boomers, have so much wealth at their disposal. They could afford to purchase the entire single family home market like 20 years at a 50% premium to current prices. They could purchase the entire single family home market for like 20 years. So the degree of concentration of wealth, the degree of that economic disparity in wealth, I think yes, like the average, person like me that is young and trying to start a family and buy a home. Yeah. Unfortunately, it doesn't matter that we can't afford to buy houses. Private equity can afford to buy houses. We're still running a very large current account deficit, meaning foreigners have to, via foreign direct investment, was one way to balance that current account. Foreigners still have to buy, housing. The upper leg of the K, private equity and wealthy boomers, right? They can all still afford it. So it kind of doesn't matter. And this is why we've seen average home price nationwide just go up and to the right. But again, once you denominate it in gold terms, same thing with S&P 500, exponential up and to the right. Once you denominate it in gold terms, it's a much different story. And again, you don't even have to use gold. We were looking at, I believe it was, here. We're looking at even the S&P 500 in euro terms, which the euro area is heavily indebted. They have their own like kind of financial and economic strains and issues. So, it's not even the most pure way of distilling the real value. And even in euro terms, the S&P 500 is down on the year. So I think that, yeah, just adjusting the way we've denominated our entire lives in dollars, whether it be wages, prices, whatever. We've used the dollar forever. That is what we know. And, historically, we've had an appreciating dollar, at least a relatively strong dollar compared to other currencies. But I think that the next decade, you should start looking at things in other ways, right? The S&P 500 in gold terms during the last period of populism declined significantly. I believe is about 85% decline in the S&P 500 in gold terms here. So, it's not to guarantee that that will happen again. But if you look at the S&P 500 in gold terms, it's basically gone straight sideways over the past 10 years. And it's probably likely to underperform gold, if I had to guess, over the next decade.
Yeah. Wow. No, that's exactly right. I mean, very interesting. Well, I think, Robert, we could go on and on. There's so many more things that we could show, and I guess we have to do this some other time because this is some real trading view wizardry, that you're doing here with all the data, and people will enjoy it. Thanks a lot for doing this. We obviously link to your channel where you do this on a regular basis, and just thanks a lot for coming on. And I guess we have to do this in the future again. But thanks for showing this. And I think that's the take home message. Try to adjust your denominator and try to value things the real way, so to say. So thanks for pointing this out.
Yeah, thanks for having me. Sorry for the hiccups. Sometimes doing it on the fly can be a little bit difficult, but yeah.
All
Yeah, thanks for
good. I
having me.
think people will have enjoyed it for sure. Thanks.
Thank you.
Okay, see you around. Thank you, Robert.